We'd like to welcome to our Lakeshore Chambers virtual luncheon. I'm Dave Ryan, and thanks for joining us today for a presentation on the U.S. economy from the President of the Federal Reserve Bank of Chicago. Our virtual meeting today is made possible by the generosity of Purdue Northwest, First Financial Bank, and First Merchants Bank, and these institutions are represented today by Dr. Tom Keon, Chancellor, Mike Schneider, Market President for Northwest Indiana, and Dale Clapp, Regional President for Northwest Indiana. Joining us today is Mr. Charles Evans, who has served as President and CEO of the Federal Reserve Bank of Chicago since 2007. Mr. Evans' research has focused on measuring the effects of monetary policy on the U.S. economy, inflation, and financial market prices. The Federal Reserve Bank of Chicago is one of 12 banks that make up our nation's central bank. As head of the Chicago Fed, Mr. Evans oversees the work of approximately 1,400 employees in Chicago and Detroit who conduct economic research, supervise financial institutions, and provide payment services to commercial banks and the U.S. government. Today's economy has been slashed dramatically as the COVID-19 pandemic has adversely impacted the entire globe. Additionally, the pandemic has had an enormous impact on the U.S. labor market and has had disproportionate effects on different industries, leading to a persistent rise in unemployment. In today's format, Mr. Evans will present his economic outlook on the U.S. economy. Following his presentation, we will entertain questions from the audience. Please welcome Mr. Charles Evans, President and CEO of the Federal Reserve Bank of Chicago.
Thank you. Thank you very much, Dave. Appreciate being invited to offer my views on the economy, and I enjoyed catching up just a few minutes ago and reminiscing about the nice tour that I took about, I think we decided 8 years ago down that way. Very nice. Hope to get back there sometime before too long. Let me just say these are my views only and not those of anyone else in the Federal Reserve system. All of us have a role to play in recovering from the pandemic, which has taken a tremendous human toll and continues to pose many challenges. I'm especially grateful for the services that healthcare and other essential workers have been providing throughout this ordeal. Their dedication has been indispensable and inspiring. We obviously have lots of work ahead of us. As the economy heals, leadership by organizations such as yours will be critical in supporting local communities and businesses and in promoting development opportunities for us to achieve more vibrant economic outcomes for everyone in society. My remarks today will focus on a few points that are fundamental for the economic outlook. I'll start with where the economy stands today. Even though growth has resumed in recent months, we are still far from the robust economy we had prior to the pandemic. Importantly, the unemployment rate is about 10% now, as compared with 3.5% last February. That was a good time. We have a long way to go to get back to normal. Second point is that the future of the recovery is inexplicably linked to the virus. Until we've made sufficient progress in controlling its spread, activity is likely to remain suppressed. Indeed, sporadic outbreaks could even result in further setbacks. Third, monetary policy, and particularly fiscal policy, have key roles to play. To date, Fed actions, the Coronavirus Aid, Relief, and Economic Security Act, and other programs have provided important support to households, businesses, nonprofit organizations, and state and local governments. The expirations of expanded unemployment insurance programs, payroll protection program, lending, and restrictions on some layoffs for firms receiving special industrial relief aid loom large for the economy. These reductions will test the true resiliency of the U.S. economy. The potential hole in aggregate demand may be large, and in my view, more fiscal relief will be needed in order to limit further damage to the economy. My baseline outlook assumes that there will be progress on controlling the virus and that additional fiscal support is forthcoming. Still, I expect it could be late 2022 before economic activity returns to pre-pandemic levels. It also will be some time before inflation picks up to reach the FOMC's 2% objective on average over some time. Of course, there are many unknowns in the outlook, and I will spend some time today talking about an important one: the potential implications of the disruptions to our educational system for the development of children's skills and for the labor force decisions of their parents. Even a one-year disruption to education or work can have lasting effects on children and parents, and thus poses an important risk to the outlook. I'll conclude with the discussion of monetary policy. The Federal Reserve has taken strong action to help the economy weather the crisis and is committed to supporting the recovery. Given my outlook, I expect this means highly accommodative monetary policy will be appropriate for some time to come. The revised statement on longer run goals and monetary policy strategy should also help clarify and support our policy goals. So let me start with where the economy is today. The virus and actions to stem its spread have upended everyday life and left a huge mark on the economy. Obviously, without that, we'd be meeting in person today. After state and local governments issued stay-at-home orders for all but essential businesses, all indicators of economic activity logged record declines in the second quarter. Gross domestic product plunged at an annual rate of almost 32%. The worst quarterly decline in the history of the national income and product accounts data going back to 1947. Now, this was expected and is a temporary huge decline, and so annualizing that is a bit unfair, but that is sort of the tradition. Activity began to recover through the spring as state and city officials relaxed restrictions to varying degrees. Starting from such a low base, we can expect to see a huge positive number for GDP growth in the third quarter. The projections from outside forecasters are centered at around a 21% annual rate. Again, annualizing that is a bit unfair, but it's fair on both sides. On its own, a number that large would be remarkable and cause for celebration. However, even with this anticipated eye-catching rebound, the level of GDP would still be about 5% below its pre-pandemic level. Furthermore, rising virus counts in some locations have delayed or reversed many reopening plans, and we are undoubtedly looking at much more modest growth in the fourth quarter. The unemployment rate for me sums up the current situation quite well. It was a horrific 10.2% in July, and this was an improvement over the shocking 14.7% high in April, and this might have been closer to 20% when you consider some measurement issues. Today, nearly 18 million people are still unemployed. Though the labor market remains poor for many, some sectors of the economy have largely recovered. Retail sales are now above their pre-pandemic level, with a notable bounce back in many goods and services that had seen the largest declines during the shutdowns. Other sectors still have a way to go. For example, manufacturing output has picked up 15% between April and July. That's a good start, but it's still only a bit more than halfway out of the hole dug during shutdown. Through this time, many companies have made significant efforts to operate safely. I regularly hear from contacts about their operational changes. Some describe accelerated adoption of technology, which has enabled many employees to work remotely. Others talk about creative solutions to help keep their workers safe, including monitoring employee and visitor health, adopting more stringent cleaning protocols, and modifying the work environment to implement social distancing. Still, challenges remain. For example, some firms face high rates of absenteeism as workers get sick, are exposed to the virus and need to quarantine, or are reluctant to come to work because of health concerns. A few of my contacts have even hired extra workers to cover the high number of absences. Clearly, these efforts are costly, but they're necessary if businesses are to continue operating through the public health crisis. I personally have been extremely impressed with the way that so many businesses and manufacturing plants in particular have been able to change their production protocols and operate in a safe environment. And they've experienced very few disruptions, certainly that were caused by spreading in their own facility more from bringing in from outside. Ultimately, the course of the recovery depends on the path of the virus and efforts to contain it. Certainly, solutions to our health issues are necessary for businesses, workers, and consumers to safely return to their usual ways. Importantly, to get the economy moving, these solutions must be effective enough to restore public confidence. Households need to feel comfortable re-engaging in normal activities such as going to work or school, riding public transit, going out to eat, and visiting a doctor's office. And businesses need to have confidence in sustainable improvements in demand in order to justify long-lasting commitments, such as major capital spending initiatives and workforce expansion. Of course, a safe and effective vaccine is the ultimate goal. Until one is available, things we already know how to do, such as social distancing and wearing masks, are very important, as are increasing testing and tracing and quarantining when anybody is found to be infected. Reintroducing restrictions on social and recreational gatherings, shutting down potential super spreader events, and enhancing protections for the elderly would also help substantially. In the meantime, we are likely to see periodic regional outbreaks of infections, which may require reimposing certain restrictions on activity and may also undermine consumer confidence and spending. As we've experienced over the past couple of months, this isn't merely hypothetical. For example, a number of indicators of economic activity and consumer confidence stalled out in late June and early July as states that reopened early and saw rising virus counts had to clamp down on activities. And while outbreaks may be localized to start, it's hard to keep them so. Our nation is highly interconnected. Just think about how difficult it would be to prevent a surge in the Chicago area from finding its way into Northwest Indiana. So doing everything we can to keep the virus under control everywhere is crucial to the economy. The course of the recovery will also critically depend on receiving substantial additional support from fiscal policy. The initial policy response in March was swift, with the Federal Reserve, Congress, and the executive branch working to provide support to the millions of households and the many thousands of businesses affected by the shutdowns. The CARES Act included direct aid to households in the form of stimulus checks and expanded unemployment insurance, helping put food on the table and pay for rent and other essential expenses. Loans and grants to businesses enabled them to stay in business, keeping workers on payrolls, meeting day-to-day expenses, and avoiding costly bankruptcies. This support was essential, but the needs remain great, and some important provisions of the CARES Act have now expired, threatening to put more vulnerable households and businesses in jeopardy. An inadequate fiscal response would significantly reduce household spending, further damage household balance sheets, and put many businesses at risk of failing. Federal assistance has also been vital for state and local governments. They are on the front lines in fighting the virus. There's a heightened need today for the social services they normally provide, and they face the additional cost of addressing social unrest. These demands come at a time when tax revenues are down significantly because of the weak economy. Unlike the federal government, state and local governments cannot run deficits. So unless federal funding is provided, state and local governments may be forced to take some difficult actions. They could cut back on the provision of health resources or other social services, which would make battling the virus and the recession even more difficult. And they might end up furloughing workers, which could have large effects, as state and local governments account for about 13% of total employment in the United States. I would note nonprofit organizations face similar challenges trying to maintain funding to provide food, educational, and other assistance to the most disadvantaged people. Partisan politics threatens to endanger additional fiscal relief. A lack of action, or an inadequate one, presents a very significant downside risk to the economy today. As you can tell from this discussion, two things I see as critical for a sustainable recovery are, one, the effective control of the virus, and two, adequate additional fiscal support. My baseline forecast assumes we will achieve both, though the health solutions in particular are not going to happen overnight. As I noted before, I expect the third quarter number to be big, positive, simply because of the restart of the economy from the most severe shutdowns of last spring. After this, I expect more moderate growth in the fourth quarter, with the level of GDP still about 5% below its pre-pandemic level at the end of this year. Improvements in our control of the virus should allow growth to proceed at a moderate pace, though I don't expect activity returning to its pre-crisis level until later in 2022. Of course, this does not take into account the fact that the economy would have been growing in the absence of the crisis. It will take much longer to catch up to that counterfactual lost growth. Economic activity remaining well below its normal level, my baseline forecast has the unemployment rate in the neighborhood of 9% by the end of the year, still extremely high, and declining gradually to somewhere around 5 or 5.5% by the end of 2022. Of course, the uncertainty surrounding these forecasts is extremely high. There are just so many unknowns about how the virus and the economy will evolve over the next couple of years. Let me say just a few words about inflation. Overall, consumer inflation stepped down significantly this spring as the effects of weak demand for a range of goods and services far outstrip price increases in food and a few other products. Even with the recovery of some prices in tandem with the recent improvements in activity, for the 12 months ending in July, inflation was only 1.3%, far below our 2% inflation target. Given the prolonged period of subpar economic growth and high unemployment, I expect inflation will run under our 2% target for some time. To sum up, even with the steady progress in controlling the virus and additional fiscal support, I expect it will be some time before the economy recovers from the hit it took. Along the way, we face many challenges, uncertainties, and downside risks. I would like to discuss one of those now. The virus presents challenges for schooling and childcare. Schooling and childcare bring together many people of different ages with a variety of health risks in the same space for prolonged periods of time. This poses enormous public health challenges in the current environment. The lack of national guidance has led to a dizzying array of educational arrangements due to differential COVID-19 risks around the country. Some schools and childcare facilities have fully reopened to in-person instruction with a wide variety of social distancing schemes. Some school districts are opting for a hybrid model, rotating online learning with classroom instruction, while others are pivoting to a fully remote learning experience. Continuing challenges for the foreseeable future will be that the health risks vary substantially around the nation and that different risk tolerances have been selected by the various state and local authorities. Furthermore, given the enormous uncertainty at this point over the course of the virus, all arrangements are subject to revision, making it even more difficult for parents to plan. For children, the lost learning and socialization costs are potentially enormous. For some children, even a year of subpar instruction can have lasting effects on their lifetime educational achievement. Furthermore, the dependence of remote learning on internet access raises the possibility of students in many rural areas and disadvantaged households being left further behind their peers. And with social activity limited by large and uncertain COVID-19 risks, I also worry that some children will miss important developmental milestones that come through interactions with other children and adults in a safe environment outside the home. Educating students at home also presents enormous challenges for parents. Can parents who work outside of the home still go to work? Who will be at home to supervise the children? If parents are able to work remotely, will they be able to do so effectively? How much flexibility do parents have to adapt to changing school demands? And what is the toll on employee and family mental well-being? These COVID-19 channels risk widespread and truly devastating costs. The added stress on families is enormous. Weighing the competing needs of family health, income, schooling, and child supervision, many parents may be forced to cut back on hours or quit work altogether. The predicament is even more striking for single parents and poorer households. And in our American society today, women are particularly vulnerable because they generally shoulder a disproportionate share of the child care and household responsibilities. For the economy, unless offset by other comparably skilled hires, a reduction in the hours worked by these parents represents a loss of current production. Furthermore, a decision to withdraw from the labor market for even a year can have long-term adverse effects on these workers, human capital, and earnings. This represents not just a loss to them, but the loss of that productivity to the economy as a whole. The human toll is very large. Though I spent a good deal of time discussing the necessity of fiscal policy, monetary policy is also playing an important role in supporting the economy during this unprecedented and challenging time. The pandemic demands an all-hands-on-deck response. Our response in the Fed has been both rapid and strong in order to limit any long-lasting damage to the economy from the challenges the pandemic poses. In March, the Federal Open Market Committee quickly cut policy rates to their effective lower bound, putting the federal funds rate target at the range of 0 to 1/4 percentage point. As the committee has repeatedly stated, the federal funds rate is likely to remain in that range until we are confident the economy is on the path to recovery. In addition, in order to address distress in crucial financial markets, the Fed conducted repurchase agreements and purchased large quantities of U.S. Treasury and mortgage-backed securities. We also activated special lending facilities to support the flow of credit to businesses, households, nonprofits, and state and local governments. These programs, which are deployed only in very unusual circumstances, rely on emergency lending powers that require the approval and financial backing of the U.S. Department of the Treasury. To broaden their scope, we've adjusted the terms on a number of facilities as appropriate. These actions have clearly provided important support to the economy by easing financial conditions across the economy. The Fed will continue to provide such support as long as needed. As always, we remain focused on the achievement of our dual mandate objectives of maximum employment and price stability as expeditiously as possible. To help us achieve these goals, in early 2019, the Federal Reserve embarked on a comprehensive effort to review the way we conduct monetary policy. Last week, Chair Jay Powell introduced a revised Statement on Longer Run Goals and Monetary Policy Strategy, the document that lays out the FOMC's goals and articulates our framework for conducting monetary policy. Among the noteworthy changes, the new statement emphasizes that maximum employment is a broad-based and inclusive goal, and that the committee would not be concerned with what might look like very tight labor markets as long as they were not generating unwanted inflation or other risks. The new statement also indicates that following a period when inflation has persistently run below our 2% target, I've been president for 13 years, and for the most part, that has been the case, policy will likely aim to generate a period of above 2% inflation. We're not tied to a strict formula, but roughly speaking, we're looking for inflation to average 2% over time. These principles are consistent with the type of outcome-based forward guidance that I've advocated in the past and that the committee used to speed the recovery after the great financial crisis, when we were far away from both our inflation and our employment goals. We're in a similar position today, and I expect that articulating outcome-based forward guidance for the rate path and asset purchases could be beneficial in the not too distant future. One of the lessons that monetary policymakers have learned is that policy is most effective when it is clearly understood by the public. I think our new consensus strategy is another important step in providing this kind of transparency and hence in helping us to more effectively achieve our policy goals. Of course, strategies need to be implemented with actions, and it is important that our future monetary policy actions are true to the principles laid out in the new consensus statement. Thanks very much for your attention, and I look forward to your questions.
Charlie, can you hear me?
I can hear you, Dave.
Thank you very much. And we do have some questions for you.
Great.
And in 2008, the U.S. experienced the worst recession in over 50 years. And in 2020, we faced the worst pandemic in over 100 years. How would you compare the impact of the 2008 U.S. recession to the impact of the global COVID-19 pandemic in 2020? And can we recover quicker in 2020 versus 2008? Right.
That's an insightful question. And it goes back to as I sort of alluded to, I've been president since 2007, and almost immediately we ended up in the great financial crisis, and we had a steep decline in output, and unemployment went up to 10%. The proximate cause of that downturn was it was a financial crisis. There had been financial excesses that had built up, and with the bankruptcy of Lehman Brothers, we ended up with lots of losses that had to be overcome and debt overhang. That was a financial crisis that the Federal Reserve monetary policy was able to address most directly. We needed fiscal policy support too, because the unemployment rate was above 10%. But as the economy began to recover, our low interest rate policy and asset purchases, I think, sped the recovery, and we could do that. The current downturn is really quite different, although the magnitudes are just as horrific. Unemployment is 10% now, but it's really, it's a public health safety risk. It's the pandemic, it's a virus. And in fact, the language that I used to describe the first half of the year, we had the worst downturn ever recorded. Well, that was sort of planned because we had to, encourage households, workers, businesses to stay home so we could get on top of the virus so that it didn't spread to, unimaginable rates. And then as we began to come out of that and get back to business, back to work, and get on top of the virus in different localities, then we were able to increase and get back. And so that was a planned downturn. And before that, we enjoyed a really good economic environment where the unemployment rate was 3.5%. Inflation was, we were hoping to get inflation up, but the economy was doing quite well. So it's really a public health safety crisis. We need to make sure that it's safe to go out. It's not enough just to sort of demand everybody go back to work and all of that. If consumers aren't comfortable going out and about, undertaking their activities, going out to restaurants and leisure activities are an important part of that. We've seen a wonderful return of activity in many sectors of the economy: manufacturing, goods production, corporate services where people can work remotely and all of that. But in so many leisure, hospitality, travel, that's not really on the table at the moment. And so we're struggling with that. So it's one where monetary policy is definitely in a second chair role, I would say. And, first responders are public health safety and fiscal policy, I would say. But yes, I do think we can recover with the right, reactions.
Another question, the emergency aid package is currently stalled in Congress. What is the impact, both short-term and long-term, of not passing another stimulus package?
Well, so, again, it sort of comes to, so I think it's substantial is the answer. I think the impact could be, quite substantial. I think we're looking at an economy which, is seeing a number of sectors being able to get back to at least 90% of their production levels. The auto sector has been quite strong. There's been a lot of pent-up demand. Consumers, businesses are rearranging how they go about doing their consumption. Credit card bills are lower because people aren't going out and eating as much and discretionary, types of things. But then there's so many other parts of the economy where people are disadvantaged. They can't go back to work. They aren't able to work remotely. They're unemployed. They were previously supported with the unemployment insurance, which was extraordinarily generous by adding $600 per week, into July. And so that really filled a hole. And I viewed that as in a period that allowed, public health officials and national leaders to get on top of the virus so that we'd be ready when that expired. Well, we still have more work to do, and that hole is going to be opening up again. And so even businesses that have enjoyed good consumption sales, for their products, when that relief becomes less evident, we're going to have to see, how deep the hole in aggregate demand is. It could be really quite an obstacle to continued growth. I mean, I think it ends up leading to a much slower recovery if we don't do more on the fiscal side. And then there's state and local governments too that are really disadvantaged in all of this. And if they have to cut back on services, if they have to cut back on employees, that's going to be another leg down on future sales.
Following up on that, and kind of conversely, what are the potential negative consequences of the unprecedented influx of cash that's been injected into the economy to provide stimulus during the pandemic? We have seen the benefits in the short run, but could there be negative consequences in the long run?
Well, it is interesting. I mean, I've talked to some bankers recently, and they were saying that their level of deposits, this cash that has been pumped out into the economy to offer relief support, it's gotten to the point where they have plenty of deposits. Do they need more? I'm not sure that's necessarily the need. And so it is the case that savings is higher because of these relief efforts. And I think that households are sort of prioritizing how they make payments and whatnot. But I think if you're unemployed, if you're part of the 10% that's unemployed, and if you're not able to more quickly return to your previous employer, or you have to find a new employer, then that additional cash isn't going to go nearly as far, and everybody has to pay the rent. And the landlords and in a lot of communities are local business people who help keep the money in those communities. And so it's going to depend differentially on, whether or not this particular community is very strong, has a lot of employment opportunities and are not subject to the virus, or whether or not they're, greatly subjected to that. This is an economy with lots of differential implications, and just being able to find workers in some locations is hard. It's a whole bunch of different types of issues. I say there's a lot of unemployment, and yet it's hard to find workers. If you're in an area that's a little more rural, that tends to have a lower unemployment rate anyway, then these can be challenges when you're in a sector that's got stronger demand, manufacturing, and then others where you're more leisure and hospitality and travel oriented. That's a more difficult environment.
Now, we've talked to a lot of workforce development groups that say that the additional stimulus, the federal stimulus, in addition to the state unemployment, has been somewhat of a deterrent in getting that workforce back to work. How do you feel about that?
Yeah, that's a really challenging question. And, I was talking to my staff just this morning about some of the implications. And so, I just met with some directors and business people in the last few days, and I kind of tried this out. I have definitely heard from them, a manufacturer who, once they got their production back up closer to where they were recalling workers. And I think the person said they had 200 workers who chose not to come back. They were scared about the safety, the virus, and all that. But they also now the plus $600 is expired too. So there are a variety of concerns that people have, but definitely there's been that challenge. Now, the economic evidence seems to be that in the labor market there's sufficient slack so that you can find other workers to replace the ones who aren't coming back. But that requires effort. It probably requires a little bit of additional training, and the 200 workers in the previous case, they were already trained. So the best match would be if they could come back, whether they have the right incentives, maybe the pay, maybe the disincentive through the insurance benefit. But it gets very complicated, and telling somebody, well, my economists tell me that the net effect on the economy isn't really that big, doesn't help the individual who is affected in a difficult situation. And even if they're able to hire workers, when it comes with additional recruiting costs, you got to look for them, you got to train them. Is the match really, really right? That's a very challenging environment. And that's just one, type of example. There are many, many others. And so I think getting everybody back, getting on top of the virus spread so that everybody feels safe, so that we can go back doing all of our activities, not just the easy ones where you buy something online and it gets delivered to you, but ones where you feel confident going out and undertaking all those retail commercial activities. We would be much stronger and in a great position when that happens.
Along the lines of the big influx of cash and so forth, the deficit is at $3 trillion and climbing. What impact does this have, recognizing it is approaching the annual GDP?
Higher debt levels means there's less capacity to undertake additional initiatives in the future. Are we, approaching critical levels like that? That's a very hard question. We've sort of addressed that over the last 10 and 15 years. We've undertaken a variety of stimulus packages or corporate tax, reform that added $2 trillion to the national debt over 10 years. And so, those are important questions. One, if you think that there's a big limitation at the moment, then you might expect that borrowing costs would be going up a lot because people would be very reluctant. They would demand compensation in order to lend as much as is required. In fact, 10-year Treasury rates are very, very low. In fact, they're lower today, but they're under 1 percentage point. And so investors at the moment are not requiring compensation in order to produce a tremendous amount of funds. Now, part of that is because there's so much cash out there, and people are looking for places to park their funds. But over time, I think we do have to understand the fiscal consequences of all of our actions, of all of our programs, and think about the best way to proceed going forward. But if we don't take action today, this year, and get on top of the virus spread, if we have to deal with this for a much longer basis, it's going to be costly, and we're going to end up with deficits and lower economic growth as well. And so it's just not for free to sort of say, we've done enough, we've got to make sure that we don't run up debts, because it's going to have other costs. But it's a very hard question.
Sure. If COVID-19 became available, the vaccine became available and distributed by early October in the US, how would that affect your GDP forecast for the fourth quarter of 2020?
I'm not an expert on, vaccines take-up rates and how quickly that would have an effect. Now, obviously, I think that fourth quarter is a bit quick of an effect. I think that would have a more positive effect on my 2021 outlook. I have embedded in my best outlook that there will be something like a vaccine coming online by the following fall in 2021. And so if it comes online earlier, if people choose to have the vaccine, and if it is effective, at the rate that it really makes people feel comfortable going out and undertaking the activities they did before, that would be stronger growth, no doubt about it. And more people working, and we could get, kids back to school. We could go back to the theater in large numbers, movies, watch athletic events unfold, and things like that. That would definitely be good. The fourth quarter, that type of boom, boom kind of impact would be most unusual, I would say. Okay. But definitely, definitely into the next year for sure.
Well, it would definitely get us back to normal. And I think that's what people are looking for, to get some semblance of normalcy. And
we are looking for that. Yes.
Unemployment is over 10%, and the stock market was over 29,000 yesterday. It's off about 600 today. Is there any correlation between the two to predict what the fourth quarter or the first quarter of 2021 might look like?
Yeah, I'm certainly not an expert at financial market forecasting in the stock market. I marvel at, the most recent performance with all of the uncertainties, and talking to business people about, if you just think about, the most recent strong economy that we had at the end of 2019, that was one with a very low unemployment rate of 3.5%, and the stock market was going up. And so I don't think there's really a great correlation between that 10% and, and all of that. Improvements in labor market, strong growth, that would, tend to support good valuations for sure, but growth in those valuations is really hard. But if you go back to 2019, one of the huge fundamentals for that growth was a strong consumer. Strong business investment was not what was making the economy grow very strongly at that time. There was actually a bit of a reluctance on businesses, to commit funds for capital expansion. And there was a lot of uncertainty having to do with trade negotiation policies and tariffs. And, those issues have not, been resolved. And I don't know what the current, what next year's situation is going to be, but additional uncertainty about the international environment. And, you know, the virus has hit, it's a global phenomenon. And so it's hit Europe, it's hit Asia. And so exactly how everybody is going to conduct business and trade with each other, and whether or not they're come to good trading relationship or not, that's a big unknown. So I don't know how that gets resolved in to the satisfaction of businesses, so that they're willing to go out and invest in a brand new factory, expand their factory, and where their supply chains are going to be. Is it going to be on the current side of the Mexican border, or is it going to be on the U.S.? You know, we've renegotiated the USMCA, but you know, how does that all play out? There's still a lot of uncertainty, and that was what we were looking at in 2019. And, you know, on the strength of that, the stock market has done what it's done. So I'm not the right person to ask about that.
Okay. Here's one, Charlie, with that. What are your thoughts on the Federal Reserve introducing the U.S. digital currency, and what impact do you foresee on the future Fed policy?
Oh, yeah, that's another great question. In fact, I was talking with some of my staff about that just yesterday. Digital currency is, you know, a very interesting issue, very important one. And if you look around the world, many foreign central banks have conducted studies on whether or not they should have a digital currency, their own. China, the People's Bank of China has embarked upon an initiative about creating a digital currency there. Exactly how it plays out, and you know, we have you know, we have a variety of digital currencies already. And, you know, from the private side. And so if you had the Federal Reserve or a, you know, central bank provide that too, I guess you'd have some competition, but you'd also have sort of a differential in terms of, you know, central bank safety, like cash, versus private providers of that, and you know, how they manage their risks and all of that. There'd be differences in terms of anonymity, in terms of a central bank digital currency. There's going to be something like a bank account. You know, how your funds move around are going to be known. That's not going to be like Bitcoin and the anonymity, where a variety of different actors can, you know, sort of conduct transactions without people seeing that. So I think that's a good thing to have more transparency. You know, I think nefarious transactions in these types of digital mechanisms is not a good thing. And so we need to make sure that we can keep our financial system safe from nefarious activities, money laundering, you know, and terrorist financing, and all kinds of things like that. So it's a very important topic to study for the United States. It gets wrapped up in the current organization of the banking system and the non-banking system. So there are a lot of issues to be thinking about. Look forward to more on that.
Okay. Before the Fed's new inflation target policy, the Fed set an inflation rate target of 2%. We've talked about this. Under the new policy, however, the Fed will seek to achieve inflation that averages 2% over time. How do you think this will impact interest rates over the mid and long term?
Well, I think this is going to be a good thing for the economy. I think this is going to be a good thing for the conduct of monetary policy. One challenge that we have had in the last 15, 20 years is that nominal interest rates have come down over a long period of time, and it's around the world. Now, that's a good thing in terms of borrowing costs, but they are nominal interest rates. As they get lower and lower, the Federal Reserve has less headroom to lower interest rates when we really need to provide accommodation when there's a downturn. So at the beginning of this year, we were only able to lower interest rates by, I believe, about 150 basis points. And you know, before that, we had lowered rates a bit. If you go back to, you know, previous times like the 80s and the 90s, the Fed would often cut interest rates by 500 basis points and more. And so providing more accommodation is important, but when we're stuck at zero and you can't cut the interest rate below zero, and nobody's a fan of negative interest rates these days. So, you know, what do? Well, one thing is you try to make sure that you hit your inflation objectives. You make sure that you hit your maximum employment mandate. And to the extent that inflation is as high as it should be, that gives us more bandwidth. And so we've had trouble getting inflation up to 2%. You know, someone like, you know, you and me, we remember the 70s and the 80s when inflation was high, and, the idea of getting inflation up doesn't seem like a normal activity for a conservative central bank or anybody, but we've had trouble getting inflation up to 2%. And we think that the current framework that we've just adopted is going to give us a little more latitude to shoot for above 2% inflation for a time so that we can average out some underperformance. And when inflation is just confidently expected to be 2% over a significant period of time, that makes your borrowing on a mortgage, long-term borrowing, that much, more, you can feel confident that that's a good decision, and variations in inflation and interest rates aren't going to really hurt you. And so I think this helps solidify that.
Charlie, you mentioned the 70s and 80s, and painfully, I remember those times because I had a commercial mortgage at 18% in the early 80s, and thanks to my father, his lending policy. But it was painful. And you look at today's mortgage rates of 2.6%, for a 30-year mortgage. It's an incredible time to borrow money, and that's the flip side of everything. But Charlie, we have reached the limit on our time, and we want to certainly thank you for your insightful presentation. And we always look forward to hearing from you, and we catch a lot of your Zoom presentations through the Fed. But we also want to thank you and your staff, and thank our sponsors, Purdue Northwest, First Financial Bank, and First Merchants Bank. And everyone have a great day, and thank you for joining us.
Thank you. Thank you very much. It's been a pleasure.
Great.